You, more than anybody I know, push against a stereotype of real estate investment trusts. OMG, we're all going to die. The stocks have cratered. Your stock is down, but you've got a 12% total return over the last 12 years. CBRE is the outlier. What is your best practice removed from the volatility train wreck of REITs?
The best practice in the regard you're talking about, Tom, is that we are very diversified. We're diversified across asset type, diversified across service type, diversified across geography, and diversified across client type. And we're very substantial across all four of those dimensions. So as things ebb and flow, as secular trends emerge, we can push resources into the areas that are favored, as we've done over the last few years by pushing resources into multifamily and pushing resources into warehouses and pushing resources into outsourcing and project management, and that's worked very well for us.
Nick Bloom is leading the academics on work from home out at Stanford. It's, we all know it's sort of grim and life-changing and all that. That part of CBRE that is in the cliche of Midtown Manhattan, sea to shining sea, that's empty. Is that going to continue? Is this legitimate emptiness that we see now?
It's a legitimate backing off of the amount of office space that'll be used, but there's some important trends that are contrary to that. So, for instance, companies in general, and certainly here in New York, there's some famous examples here in New York of leaders that want to get their people back in. Well, the way you get your people back into the office is you create great environments in that office space. And so what you see across New York for the past several quarters, even though office leasing is down, and in the first quarter it was down by about a third year over year, we are running ahead of pre-pandemic levels as it relates to high-priced office leases because people want to be in those best buildings.
I got a brilliant idea. CBRE takes over the Lincoln Tunnel. That'll fix Midtown Manhattan.
Well, yes, perhaps we'll have a fancy Lincoln Tunnel. This is the issue, though. You have dead office space that isn't retrograde, that isn't retrofitted for the sort of fancy experience. What happens to that? Are there just basically no-man lands of old office space that no one wants?
Well, Lisa, we'd love to have an answer for everything, but we don't. And one of the quandaries we're faced with as an industry is there are going to be some antiquated office buildings, and it hasn't been figured out yet what's going to happen. There's a lot of talk about can you convert them to multifamily residential. Some of them you can. Ironically, the ones that are most able to do that are the older, smaller floor plate buildings. Some of the ones that were built in the 70s and 80s with the very large floor plates and a small amount of elevators relative to the floor plates, et cetera. It's just not practical to convert them into residential, so we'll have to see what happens with those.
There's a larger question here, especially as we're on the precipice of some change in the economic cycle. We don't know when, we don't know what, but it seems as though there has to be a right sizing with housing prices that have remained resilient and rents that have come down, with an economy that is stagnating in certain areas, and even with commercial rents staying relatively elevated. Which is going to give? Are valuations going to fall more in the property, or are rents going to fall?
I don't think you're going to see you're talking multifamily
Most
residential.
of that, yeah.
I don't think rents are going to fall a lot in multifamily residential, and the simple reason for it is even though you have interest rate issues, et cetera, demand supply is still very real in that product type like it is in most product types. And the fact of the matter is you still have slightly less than average historical vacancy rates in multifamily residential. And those high interest rates are causing single-family homes to be more expensive, which is pushing people into multifamily rental properties. So I don't think you're going to see a big decline in rental rates at all.
I got 8 ways to go here. I could go to Miami. I could go to Europe and, talk about what you're doing in Los Angeles or, frankly, boom southern economies where everybody from New York's moving to, including your Texas as well. Forget about it. Let's go to the Pacific Rim in China. CBRE has a prism on Asia like no one. Do you buy the idea that the West can continue to work with China and that they'll see stability in their property market, which is the mother of all volatile markets?
Well, I was in Asia, in Hong Kong, about 3 weeks ago, And like so many things, Tom, the news, the sensationalism around the political challenges.
What's the reality there that you
The
see?
reality there is that we're doing a lot of business in China, and our business in China is growing. And there's a lot of business being done between the U.S. and China, and a lot of effort
Okay.
to get U.S. companies in there. There is political risk for sure, but those are the largest cities in the world, or some of the largest cities in the world. And one of the things that's happening as it relates to commercial real estate is intermediation, which we've had here and in Western Europe and in parts of Asia forever, but not so much in China, is becoming more and more prominent there. So we expect to grow our business substantially.
Before we let you go, and unfortunately it is too short, I do want to just get your view on what the pricing impact is going to be of some of these regional banks with pretty big portfolios of loans that back commercial real estate. What is the likelihood of some forced sales that really bring down prices in the near term?
There's going to be some forced sales, Lisa, but here's something that it just gets missed. If you look at commercial banks' assets across the United States, less than 1.5% is in office buildings, is in office building loans. So, yeah, there is some pressure now with less capital available, less debt available from commercial banks for office buildings. It's being backfilled by other sources of capital, private sources of capital, debt funds, et cetera, the GSEs. There is going to be down pressure. There is going to be some trouble as it relates to the regional banks, but it is certainly not huge in a way that would be ruinous for the commercial bank industry.
What about other sectors within the real estate? Are there other areas that are more exposed based on the concentration of these banks?
Fundamentals are really good in other areas. And when I talk about fundamentals, occupancy rates and rental rates. So just to give you a few, industrial, 3.5% vacant. Institutional quality multifamily, less than 5% vacant. Retail rents are on their way up around the U.S. Hotels doing very well. So the fundamentals in things other than office are actually quite good right now. I'm sure both of you have had experiences trying to get into restaurants lately. I mean,
Oh, no.
It's
No. I don't have a life. Lisa has a life. Pharaoh has a life. I don't have a life.
So again, headlines are partially accurate, anecdotally accurate, but not holistically
Do you realize
accurate.
Sulentic he just shows up at any restaurant across the country and
They
it's
just
like,
open.
Bob,
Yeah, absolutely.
Bob, please, did you get the check? Bob Sulentic.
As long as it's fast food.
Bob Sulentic.